everyone, and welcome to WITI Conversations. I'm Kayla, the host of the show, and on today's show, we're going to talk about exchange-traded funds. Maybe it's something that you heard about, maybe it's something that you haven't, but it's something that you should know about. So today, we're going to break down what an ETF is. We're going to look at a breakdown of different types of ETFs and some examples of ETFs, and we're going to compare ETFs to stocks and to mutual funds. So let's dive right in. Exchange traded fund is more commonly referred to as ETFs. And to understand what that is, we can literally take that phrase, exchange traded fund, and work it backwards. It's a fund that's traded on an exchange. Now that sounds pretty obvious, but what I mean by that is that what typically trades on an exchange that we think of is stocks. But a stock represents a company. This exchange traded fund is a fund that actually holds a basket of ingredients. So a basket of assets that could be commodities, that could be bonds, that could be individual stocks, but a number of them as opposed to one individual stock. And so it doesn't represent an individual company like a stock does, but it trades on an exchange like a stock does. And so that's what an ETF is. Let's take a look at different examples of ETFs. We have the US equities, broad markets, SPY, QQQ, IWM, and MDY are the main broad markets. MDY is also DIA, represents the Dow Jones. Those are the four big ones there. And actually, SPY was the very first ETF to ever be created back in 1993. Woo! Some time ago. We also have different sectors, non-US equities, real estate funds, and junk bonds. We also have other bonds, other investment grade bonds, long-term US securities, long-term US treasuries, precious metals, gold and silver, and oil, other foreign currencies. So these are just some of the main ETFs, but there's a bunch of ETFs out there. And some of those ETFs, for example, the ETFs that represent gold. There's an ETF that actually is a fund that has physical gold in it. It holds physical gold. But there's also gold-related ETFs that would have companies that are gold mining companies. So that's going to closely correlate with the price of gold, but it doesn't necessarily track gold itself. So there's ETFs for a number of different things there. Now let's take a look at some of the differences between ETFs, stocks, and mutual funds. Now, because this is a fund, there is diversification benefits. So between ETFs and mutual funds, they both have multiple assets inside of them. And so for that reason, they're diversified, unlike a stock. A stock is subject to, bad news or even good news for an individual company. That's going to greatly affect the price of that stock. Now, if that stock forms part of a fund, now it's just one piece of the puzzle. And so that news that might greatly affect the price will average into this fund, and it won't cause as big of an impact. And so you're kind of safer with that, or it's a diversified play at least. There's fewer fees when it comes to ETFs than there are with mutual funds. Stocks, you don't have that, but with any type of fund that has some sort of management involved, there are fees. So with mutual funds, though, you'll see that the fees are much higher than they are for ETFs. Another thing that you have with an ETF, like you do with stocks, is intraday pricing, something that mutual funds don't have. So something that ETFs have, like stocks have, is intraday pricing. And mutual funds don't have this. When we think about buying a stock, you can buy or sell that stock at any time that the market is open. But with mutual funds, they only are priced at the very end of the day. So imagine that you see the market falling. It's crashing, and you see it happening before your eyes, but you can't do anything about it. That's what it is with a mutual fund. When it starts to crash, there's nothing you can really do about it. It's getting priced at the end of the day. Whereas an ETF actually has intraday pricing. You can do something about that. You could get out of that position. So that's a big benefit that ETFs have over mutual funds, and that they have in common with individual stock. Let's take a look at a couple different types of ETFs. There's inverse ETFs, which are constructed to represent the inverse of a security. Some examples, we have SH, which is the inverse of SPY, and PSQ, the inverse of QQQ. So essentially what that means is that if SPY goes up, SH is constructed to go down, essentially the same amount that SPY goes up, hence the inverse there. So if you were to buy SH, you're betting that SPY, the S&P, will go down, and vice versa. If you sell short, then you're betting that the S&P will go up. Now there's also leveraged ETFs, and this is an ETF that amplifies the movement of a security that it tracks. So for example, SSO and SPUU are twice the S&P, whereas UPRO and SPXL are 3 times SPY. What does that even mean? Well, that means that if you were to buy, say, SSO, then in theory, every time that the S&P goes up a unit of 1, SSO would go up twice that value. There's also a third one in here that we're going to include, which is inverse leveraged ETFs. An ETF that combines the two, it's both leveraged and it's the inverse. So some examples would be STS, the negative twice of the SPX, and SPXU, which is negative 3 times SPY. So as you can see, there are tons of ETFs out there, tons of different types of ETFs and the way that they're constructed. There's so many types of ETFs. There's ETFs for space exploration. There's an ETF for millennials that's tracking the companies that millennials are into, like Uber or Apple. There's space exploration, nicely titled UFO. There's whiskey, WSKY, tracking whiskey and spirits, and there's even a fund of funds. So it's a fund that contains other funds in it. So, kind of like Leonardo DiCaprio getting back to Inception, like a dream in a dream, but a fund in a fund. No, I'm just kidding. But there's tons of ETFs that are out there, and now you know the difference between an ETF, a stock, and a mutual fund, some of the pros and cons in there, and you've got some more information under your belt. That's it for this witty conversation. Join us next time for some more.